E. Value investing, a redundancy. We don't see many fundamental differences between the purchase of a controlled business and the purchase of marketable holdings. In each case, we try to buy into businesses with favorable long-term economics. Our goal is to find an outstanding business at a sensible price, not a mediocre business at a bargain price. Charlie and I have found that making silk purses out of silk is the best we can do. With sow's ears, we fail. It must be noted that your chairman, always a quick study, required only 20 years to recognize how important it was to buy good businesses. In the interim, I searched for bargains and had the misfortune to find some. My punishment was an education in the economics of short-line farm implement manufacturers, third-place department stores, and New England textile manufacturers. Of course, Charlie and I may misread the fundamental economics of a business. When that happens, we will encounter problems whether that business is a wholly owned subsidiary or a marketable security, although it is usually far easier to exit from the latter. Indeed, businesses can be misread. Witness the European reporter who, after being sent to this country to profile Andrew Carnegie, cabled his editor, "My God, you'll never believe the sort of money there is in running libraries." In making both controlled purchases and stock purchases, we try to buy not only good businesses, but ones run by high-grade, talented, and likable managers. If we make a mistake about the managements we link up with, the controlled company offers a certain advantage because we have the power to effect change. In practice, however, this advantage is somewhat illusory. Management changes, like marital changes, are painful, time-consuming, and chancy. I would say that the controlled company offers two main advantages. First, when we control a company, we get to allocate capital, whereas we are likely to have little or nothing to say about this process with marketable holdings. This point can be important because the heads of many companies are not skilled in capital allocation. Their inadequacy is not surprising. Most bosses rise to the top because they have excelled in an area such as marketing, production, engineering, administration, or sometimes institutional politics. Once they become CEOs, they face new responsibilities. They now must make capital allocation decisions, a critical job that they may have never tackled and that is not easily mastered. To stretch the point, it's as if the final step for a highly talented musician was not to perform at Carnegie Hall, but instead to be named chairman of the Federal Reserve. The lack of skill that many CEOs have at capital allocation is no small matter. After 10 years on the job, a CEO whose company annually retains earnings equal to 10% of net worth will have been responsible for the deployment of more than 60% of all the capital at work in the business. CEOs who recognize their lack of capital allocation skills, which not all do, will often try to compensate by turning to their staffs, management consultants, or investment bankers. Charlie and I have frequently observed the consequences of such help. On balance, we feel it is more likely to accentuate the capital allocation problem than to solve it. In the end, plenty of unintelligent capital allocation takes place in corporate America. That's why you hear so much about restructuring. Berkshire, however, has been fortunate. At the companies that are our major non-controlled holdings, capital has generally been well deployed and in some cases, brilliantly so. The second advantage of a controlled company over a marketable security has to do with taxes. Berkshire, as a corporate holder, absorbs some significant tax costs through the ownership of partial positions that we do not when our ownership is 80% or greater. Such tax advantages have long been with us, but changes in the tax code caused them to increase significantly during 1986. As a consequence, a given business result can now deliver Berkshire financial results that are as much as 50% better if they come from an 80% or greater holding rather than from a lesser holding. The disadvantage of owning marketable securities are sometimes offset by a huge advantage. Occasionally, the stock market offers us the chance to buy non-controlling pieces of extraordinary businesses at truly ridiculous prices, dramatically below those commanded in negotiated transactions that transfer control. For example, we purchased the Washington Post stock in 1973 at $5.63 per share, and per share operating earnings in 1987 after taxes were $10.30. Similarly, our Geico stock was purchased in 1976 1979, and 1980 at an average $6.67 per share, and after-tax operating earnings per share last year were $9.01. In cases such as these, Mr. Market has proven to be a mighty good friend. Our equity investing strategy remains little changed from what it was when we said in the 1977 annual report. We select our marketable equity securities in much the way we would evaluate a business for acquisition in its entirety. We want the business to be one, A, that we can understand, B, with favorable long-term prospects, C, operated by honest and competent people, and D, available at a very attractive price. Because of both market conditions and our size, we now substitute an attractive price for a very attractive price. But how, you will ask, does one decide what's attractive? In answering this question, most analysts feel they must choose between two approaches customarily thought to be in opposition: value and growth. Indeed, many investment professionals see any mixing of the two terms as a form of intellectual cross-dressing. We view that as funny thinking, in which, it must be confessed, I myself engaged some years ago. In our opinion, the two approaches are joined at the tip. Growth is always a component in the calculation of value, constituting a variable whose importance can range from negligible to enormous, and whose impact can be negative as well as positive. In addition, we think the term value investing is redundant. What is investing if it is not the act of seeking value at least sufficient to justify the amount paid? Consciously paying more for a stock than its calculated value, in the hope that it can soon be sold for a still higher price, should be labeled speculation, which is neither illegal, immoral, nor, in our view, financially fattening. Whether appropriate or not, the term value investing is widely used. Typically, it connotes the price of stocks having attributes such as low ratio of price to book value, a low price earnings ratio, or a high dividend yield. Unfortunately, such characteristics, even if they appear in combination, are far from determinative as to whether an investor is indeed buying something for what it is worth, and is therefore truly operating on the principle of obtaining value in his investments. Correspondingly, opposite characteristics, a high ratio of price to book value, a high price earnings ratio, and a low dividend yield are in no way inconsistent with a value purchase. Similarly, business growth per se tells us little about value. It's true that growth often has a positive impact on value, sometimes one of spectacular proportions. But such an effect is far from certain. For example, investors have regularly poured money into the domestic airline business to finance profitless or worse growth. For these investors, it would have been far better if Orville had failed to get off the ground at Kitty Hawk. The more the industry has grown, the worse the disaster for owners. Growth benefits investors only when the business in point can invest at incremental returns that are enticing. In other words, only when each dollar used to finance the growth creates over $1 of long-term market value. In the case of a low-return business requiring incremental funds, growth hurts the investor. In The Theory of Investment Value, written over 50 years ago, John Burr Williams set forth the equation for value, which we condense here. The value of any stock, bond, or business today is determined by the cash inflows and outflows, discounted at an appropriate interest rate, that can be expected to occur during the remaining life of the asset. Note the formula is the same for stocks as for bonds. Even so, there is an important and difficult to deal with difference between the two. A bond has a coupon and maturity date that define future cash flows, but in the case of equities, the investment analyst must himself estimate the future coupons. Furthermore, the quality of management affects the bond coupon only rarely, chiefly when management is so inept or dishonest that payment of interest is suspended. In contrast, the ability of management can dramatically affect equity coupons. The investment shown by the discounted flows of cash calculation to be the cheapest is the one that the investor should purchase, irrespective of whether the business grows or doesn't, displays volatility or smoothness in its earnings, or carries a high price or low price in relation to its current earnings and book value. Moreover, though the value equation has usually shown equities to be cheaper than bonds, that result is not inevitable. When bonds are calculated to be the more attractive investment, they should be bought. Leaving the question of price aside, The best business to own is one that over an extended period can employ large amounts of incremental capital at very high rates of return. The worst business to own is one that must or will do the opposite. That is, consistently employ ever greater amounts of capital at very low rates of return. Unfortunately, the first type of business is very hard to find. Most high-return businesses need relatively little capital. Shareholders of such a business usually will benefit if it pays out most of its earnings in dividends or makes significant stock repurchases. Though the mathematical calculations required to evaluate equities are not difficult, an analyst, even one who is experienced and intelligent, can easily go wrong in estimating future coupons. At Berkshire, we attempt to deal with this problem in two ways. First, we try to stick to businesses we believe we understand. That means they must be relatively simple and stable in character. If a business is complex or subject to constant change, we are not smart enough to predict future cash flows. Incidentally, that shortcoming doesn't bother us. What counts for most people in investing is not how much they know, but rather how realistically they define what they don't know. An investor needs to do very few things right as long as he or she avoids big mistakes. Second, and equally important, we insist on a margin of safety in our purchase price. If we calculate the value of a common stock to be only slightly higher than its price, we're not interested in buying. We believe this margin of safety principle, so strongly emphasized by Ben Graham to be the cornerstone of investment success. An intelligent investor in common stocks will do better in the secondary market than he will do buying new issues. The reason has to do with the way prices are set in each instance. The secondary market, which is periodically ruled by mass folly, is constantly setting a clearing price. No matter how foolish that price may be, it's what counts for the holder of a stock or bond who needs or wishes to sell, of whom there are always going to be a few at any moment. In many instances, shares worth X in business value have sold in the market for 1/2 X or less. The new issue market, on the other hand, is ruled by controlling stockholders and corporations, who can usually select the timing of offerings or, if the market looks unfavorable, can avoid an offering altogether. Understandably, these sellers are not going to offer any bargains, either by way of a public offering or in a negotiated transaction. It's rare you'll find X for 1/2 X here. Indeed, in the case of common stock offerings, selling shareholders are often motivated to unload only when they feel the market is overpaying. The sellers, of course, would state that proposition somewhat differently, averring instead that they simply resist selling when the market is underpaying for their goods. Right after year-end, Berkshire purchased 3 million shares of Capital Cities ABC Incorporated, Cap Cities, at $172.50 per share. The market price of such shares at the time of the commitment was made early in March 1985. I've been on record for many years about the management of Cap Cities. I think it is the best of any publicly owned company in the country, and Tom Murphy and Dan Burke are not only great managers, they are precisely the sort of fellows that you would want your daughter to marry. It is a privilege to be associated with them, and also a lot of fun, as any of you who know them will understand. Our purchase of stock helped Cap Cities finance the $3.5 billion acquisition of American broadcasting companies. For Cap Cities, ABC is a major undertaking whose economics are likely to be unexciting over the next few years. This bothers us not an iota. We can be patient. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. As evidence of our confidence, we have executed an unusual agreement. For an extended period, Tom as CEO, or Dan, should he be CEO, votes our stock. This arrangement was initiated by Charlie and me, not by Tom. We also have restricted ourselves in various ways regarding sale of our shares. The objective of these restrictions is to make sure that our block does not get sold to anyone who is a larger holder, or intends to be a larger holder, without the approval of management, an arrangement similar to ones we've initiated some years ago at Geico and Washington Post. Since large blocks frequently command premium prices, some might think we have injured Berkshire financially by creating such restrictions. Our view is just the opposite. We feel the long-term economic prospects for these businesses, and thus for ourselves as owners, are enhanced by the arrangements. With them in place, the first-class managers with whom we have aligned ourselves can focus their efforts entirely upon running the businesses and maximizing long-term value for owners. Certainly, this is much better than having those managers distracted by revolving door capitalists hoping to put the company in play. Of course, some managers place their own interests above those of the company and its owners and deserve to be shaken up, but in making investments, we try to steer clear of this type. Today, corporate instability is an inevitable consequence of widely diffused ownership of voting stock. At any time, a major holder can surface, usually mouthing reassuring rhetoric but frequently harboring uncivil intentions. By circumscribing our blocks of stock as we often do, we intend to promote stability where it otherwise might be lacking. That kind of certainty, combined with a good manager and a good business, provides excellent soil for a rich financial harvest. That's the economic case for our arrangements. The human side is just as important. We don't want managers we like and admire, and who have welcomed a major financial commitment by us, to ever lose any sleep wondering whether surprises might occur because of our large ownership. I have told them there will be no surprises, and these agreements put Berkshire's signature where my mouth is. That signature also means the managers have a corporate commitment, and therefore need not worry if my personal participation in Berkshire's affairs ends prematurely, a term I define as any age short of 3 digits. Our Cap Cities purchase was made at a full price, reflecting the very considerable enthusiasm for both media stocks and media properties that have developed in the recent years, and that, in the case of some property purchases, has approached a mania. It's no field for bargains. However, our Cap Cities investment allies us with an exceptional combination of properties and people, and we like the opportunity to participate in size. Of course, some of you probably wonder why we are now buying Cap Cities at $172.50 per share, given that your chairman, in a characteristic burst of brilliance, sold Berkshire's holdings in the same company at $43 per share in 1978 to 80. Anticipating your question, I spent much of 1985 working on a snappy answer that would reconcile these acts. A little more time, please.